Hello and welcome, ladies and gentlemen. My name is Samir Shah, and I'm an M&A partner in Khaitan's corporate M&A group. Welcome to the 10th and final edition of this year's M&A Academy program. We started this initiative to deliver corporate-style training and provide foundational legal knowledge and understanding on M&A transactions to corporate executives, in-house legal teams, and other M&A ecosystem participants. And we must say, the response has been nothing short of stupendous. If we see the number of online views of our recordings and the ever-increasing registrations, we would indeed be tempted to treat this as a success. Our subject today is key tax issues in M&A transactions for sellers. We covered buyer tax issues in our preceding session. And a transaction, as we know, is always a mixture of competing priorities and commercial requirements. The buyer tax issues we spoke of in the previous session are therefore incomplete unless we view the same space from the seller's perspective. Consistent with our format, we will have a presentation, and post the presentation, we will have a Q&A session with audience questions. Please continue to submit your questions using the webinar portal. We will respond offline over email to questions we cannot address today. We will also send the presentation, certain summary notes, and a recording of this webinar to you afterwards. As always, all of our recordings will be uploaded on Khaitan & Company's YouTube channel. Please remember the recording of earlier webinars are also available. To introduce our speaker today, we have with us my partner Ritu Shaktawat, who is a tax practitioner based in our Mumbai office, although she works on projects nationally and internationally. We circulated her profile over email to everyone who registered for this webinar, and you may have seen that she has advised on many high-stake transactions and is an expert in this field. So without further ado, I now invite Ritu to deliver her presentation. Over to you, Ritu.
Thank you, Samir. Hello and good afternoon, everyone. So seller tax issues in an M&A transaction are critical to any deal structure. Therefore, it's important for sellers to understand how their tax costs could change depending on the structure they finalize. And if there are alternatives, then look at those alternatives if those alternatives provide any tax efficiency to the sellers from their overall tax cost perspective. So today we'll be talking about certain common deal structures and how tax consequences vary in each deal structure for the sellers. We'll also talk about certain structuring drivers which sellers should be aware of when planning a sale event. Then we'll also cover some deal-related considerations, which are some good-to-know points for sellers when they are planning a sale transaction. And then we will also cover some of the agreement or transaction documentation-related aspects like indemnities, warranties, how scope of those also vary depending on the structure of the transaction. And then we'll close the session with takeaways and we'll take questions. So let's talk about an asset transfer as the mode of sale, which is a simpler form of a sale transaction, where seller would sell an asset or more than one asset for specified consideration. From a tax perspective, seller's tax incidence would depend on the nature of asset transferred. In case of a depreciable asset, the gains are treated as short-term in nature, regardless of the period for which the seller may have held the asset. And therefore, all gains on sale of depreciable assets are recognized as short-term in nature and taxable as ordinary income. In case of non-depreciable assets, the period of holding is relevant. Let's take an example of land, real estate. If land is held for more than 2 years, then the gains are taxable as long-term in nature and the tax rate there is 20% plus surcharge cess. If it's a short-term asset, then ordinary rates apply. From a valuation perspective, this is an area which sellers should pay attention to because this could impact the tax payable by the sellers. Under tax law, we have minimum valuation requirements, which basically prescribe that if a transaction in specified goods or assets is below the value which is recognized for tax purposes, then the seller will have to pay capital gain taxes based on the value computed as per tax rules. And there are different tax rules under law relating to different assets. So in the context of an asset transfer, if the asset in question is real estate, then the stamp duty value or the ready reckoner value of the real estate is deemed as the minimum consideration at which sale should be happening. So if the sale is happening at that price or above that price, seller would not have any tax implications on a deeming basis. But if the transaction happens at a price which is below such value as per tax rules, then the seller will have to pay taxes on notional income by considering stamp duty value as the deemed consideration, and the actual lower consideration will be ignored for seller tax purposes. In terms of another important compliance requirement that sellers should be aware of is a new provision, fairly recent provision that has been introduced, which is tax collection at source obligation on sellers in relation to sale of goods. Now, generally, of course, we come across buyers' obligations, right? Buyers' obligation to withhold tax, buyers' obligation to deduct tax when they are making payments to sellers. But this one is different in scope, which requires sellers to collect tax from the buyers and deposit it with the government. The tax rate is 0.1% of the consideration exceeding 5 million rupees. And there's one more threshold that's applicable, which is sellers having turnover exceeding 10 crores in the preceding years. Only those sellers are required to comply with this obligation. Buyers also have a similar obligation to deduct tax under another provision with similar thresholds. So in terms of priority, one needs to first check if buyer is withholding tax on a transaction. If not, then sellers is required to collect tax. So it's one of the two is applicable. Both TDS and TCS are not applicable to the same transaction. In terms of a numerical example to understand what's the impact or the amounts involved could be. So let's say a transaction is happening for 15 million rupees as consideration for sale of goods. Threshold there is 5 million or 50 lakh rupees. In that case, seller will have to collect 10,000 rupees from the buyer as tax at source and deposit it with the government. So sellers would need to make sure that they collect 10,000 over and above 15 million, because credit of this 10,000 tax will be available to the buyers. If you see, the tax rate is pretty nominal. So the government's intention is not to really collect tax at source, but to ensure that transactions like these are reported upfront. What is goods? That's not defined under Income Tax Act. So generally speaking, any movable asset can be considered as goods, and therefore sellers should look at this depending on the nature of assets being transferred in an asset transaction. Now, if we talk about business transfers, conceptually, of course, business transfer is a different transaction compared to an asset transfer. In a business transfer, the tax concept which is relevant is slump sale. Business transfers are referred to as slump sale under the Income Tax Act if they specify the requirements or criteria which is applicable in the context of slump sale. What is that criteria? So let's take an example of a manufacturing business. If a buyer is intending to buy a manufacturing business from an interested seller, then seller may not just be transferring the plant and machinery, but seller would transfer all assets and liabilities which are relating to the manufacturing business vertical. Those could be, let's say, raw materials in business, any debtors, any creditors relating to that business, factory building, even employees who are engaged in the manufacturing activity. So the whole business unit is transferred as a single unit for a lump sum consideration. And if that happens, then special computation mechanism is applicable to such transactions, where we don't look at each asset individually, but we look at the whole business unit. And if seller has been conducting that business for more than 3 years, then gains are recognized as long-term in nature. So this is where it is different from an asset transfer, because in an asset transfer, we look at each asset individually, we assess whether the asset is depreciable, non-depreciable, and then look at whether period of holding is relevant or not. But in a business transfer, period of holding of the business activity is indeed relevant. And if it's being held for or being carried out for more than 3 years, then the gains are recognized as long-term. In terms of valuation requirements, even business transfers are subject to a minimum valuation requirement. That's also a recent introduction to tax regime. As per these rules, generally speaking, the rules look at the book value of the assets minus book value of the liabilities moving in a business transfer and consider that as the minimum value at which the transaction should be happening. The only exception is with respect to assets like real estate or any investments or shares, if any such assets are moving as part of the business, in which case such assets need to be separately fair valued and book value is ignored of these assets. Whether TCS is applicable, so like we discussed in the context of asset sales, there's a provision requiring sellers to collect tax at source from buyers when it is a sale of goods. So the question is, can a business unit be considered as goods for this provision to trigger? Now, answer there may not be straightforward because we don't have a clarification from the government clarifying it one way or another. But we do believe that it's a reasonable position to take that a business unit should not be treated as goods, and therefore sellers should not be required to collect tax at source from the buyers in a slum sale or a business transfer transaction. Now let's talk about a share transfer. Share transfer is again a very different deal structure compared to an asset or a business transfer. In a share transaction, shareholders would be selling shares of the entity which may be holding target assets or which may be carrying out the target business which a buyer may be interested in. From a seller's tax perspective, seller's tax costs would depend on tax residential status of the sellers. If the shareholder is an Indian resident, then gains will be taxable as long-term in nature or short-term, depending on the period of holding. If the gains are long-term, then the tax rate applicable is 20%. And for shares, the threshold is 2 years to assess whether the asset is held on a long-term basis or short-term basis. In case of a non-resident shareholder, the tax rate is 10% on long-term gains and ordinary rates for short-term gains. From a valuation perspective, again, very important to focus on in share deals because tax laws do have a minimum valuation requirement in the context of share deals as well. And the rules vary depending on whether the shares are equity in nature or preference. For equity shares, again, largely it's a book value based valuation method, except where the entity whose shares are valued is holding real estate or investments, in which case these assets need to be fair valued separately and their book values are not considered. For preference shares, the valuation method is open market value. So the shares, the price that shares would fetch when sold in the open market, that's the valuation requirement. So a specific valuation should be carried out to determine what these values are. And so long as this transaction is happening above that value, there are no deeming tax implications for the sellers. But if transaction happens at a discount to such value, then sellers would have to still pay tax basis the value computed as per tax rules, and the actual lower consideration will be ignored. Whether TCS applies on sale of shares under the same provision, which is TCS on sale of goods. This is an area which is unclear as of today because, again, we don't have a clarification from the government clarifying whether they intend to cover shares also within the purview of this provision. But what we are seeing is that market view is kind of developing around it, and there's more and more compliance happening with this TCS provision because generally sellers would want to be more conservative rather than aggressive, where they already have tax registrations in place, so it does not cast any additional compliance burden on the sellers, and the tax rate is also nominal. Like we discussed previously, if buyer is withholding tax on the transaction, then seller is not required to collect tax. So therefore, sellers should be aware of a possible withholding happening on the transaction, depending on the tax residential status of the sellers. If it's a resident seller, then buyer, based on its own assessment, may be withholding taxes under the same provision, which requires them to withhold tax on purchase of goods. The rate there is 0.1% of consideration, subject to prescribed thresholds. And for non-resident sellers, the entire applicable tax is required to be withheld by buyers at source. So therefore, TCS obligation of sellers in a share transaction would need to first take into consideration as to whether there's any withholding happening on the transaction. If not, only in those cases one would need to analyze whether TCS applicable, not applicable, what are the arguments against, what are the arguments in favor of that position, and then take a call. After having discussed an overview of how taxability changing depending on the deal structure, let's talk about some deal structuring related considerations. So first and foremost, it's going to be the commercial objective of the parties. What are parties intending to buy and sell? Is it just an asset? Is it a business unit? Or is it the whole entity? So commercial objective of seller buyer would be one of the key structuring drivers in a transaction, in a sale transaction. Coming to some of the tax specific points, asset versus business transfer, like we have discussed, the tax rates are different, valuation principles are different, but generally speaking, if a business is being run for more than 3 years, then since the gains will be long-term in nature, a business transfer or a slump sale should result in better tax costs or better tax result for the sellers, as it will be generally tax efficient compared to an asset deal, because in asset deal we look at each asset individually, while in a business unit we look at the whole business unit and then apply the special computation mechanism that's available under tax rules. Next will be whether GST, from a GST perspective, which option is better. So an asset transfer would generally be subject to GST, and sellers would typically recover GST costs from buyers. So that's an additional cash flow issue for buyers, even if GST is a creditable tax for them. In a business transfer, GST should not apply. So even from a GST cash flow issue perspective, a business transfer should generally be better compared to an asset transfer when we talk about the deal structure. Now let's talk about share sale. Share sale would generally be most tax efficient if we just consider the overall effective tax cost from a shareholder perspective. And for that, let's look at how share sale could be more efficient compared to an asset or a business transfer. So in an asset or a business transfer, the entity holding assets or business would be transferring the assets or business and receiving consideration and will pay applicable tax on it. But shareholders do not get access to those funds unless company distributes those funds to the shareholders, because company is a separate legal entity. And if any distribution happens, say by way of dividends, that's going to be another taxable event. So in an asset or a business transfer, we're looking at two potential taxable events, which means a higher overall tax incidence. In a share sale, on the other hand, shareholders will be selling shares, receiving consideration and paying taxes on it. So there's just one step in which sellers will get access to the consideration and will pay tax on it. So it's a single event and therefore lesser overall tax incidence compared to an asset or a business transfer deal structure. If shareholders are non-residents of India, then there will be even more tax efficient result, because for non-resident sellers, there is a concessional 10% capital gain tax rate available if the shares have been held on a long-term basis. And if sellers are coming from a treaty jurisdiction which has an exemption for capital gain taxes in India, then share sale would be even more efficient because the tax rate would reduce to nil. So therefore, if a transaction is structured as a share sale, where let's say the company is holding the target assets or target business, then from a selling shareholder's perspective, a share sale should work out to be the best option from an overall tax incidence perspective. Now let's look at some other larger deal related points which a seller should generally be aware of when planning or when entering into deal negotiations with buyers. So like we discussed, sellers should be evaluating optimum deal structure at the right stage in deal negotiations so that it has a clear understanding of what works best for the sellers. And if one structure works best for the seller while its buyers don't like it for any reason, then sellers could at least identify what will be the additional tax impact on them is going to be because of a structure preferred by the buyer, and if that can be somehow in whole or part be covered as part of the deal pricing or in any other form, so that seller is not burdened with an additional tax cost just because seller is willing to accommodate a structure which is preferred by the buyers. Generally, buyers may prefer an asset transfer purely because in an asset transfer, buyers have the flexibility to exclude all liabilities. So in deals like deals in the services sector, where let's say the main asset could be employees or IP in the business, then buyers may not be willing to structure that as a business transfer, because in that case some liabilities may also flow through to the buyer. So in those deal structures, buyers may generally prefer an asset transfer so that they're able to exclude all liabilities. In global deals having India assets or India leg, it's another important area which requires sellers to focus on is the valuation which is allocated to the India leg of the transaction. And this valuation is different from what we have discussed previously. There are two reasons here. One is, let's say there's a large group in the US which has presence all around the world and has an India business or an India subsidiary as well, and that is proposed to be sold to another another group in the US. Then this larger global transaction will have one of its assets as the India asset, and therefore what value is allocated to the India asset would be important, because if tax authorities become aware of the larger global deal, they may want to make sure that the value that the parties allocated to the India leg is on a fair value basis, so that India is not losing tax on what is due to the jurisdiction on a fair value basis. That's one of the general or a good to follow kind of a practice, that whatever in a global deal having India leg, fair value basis allocation is undertaken to the India leg to avoid any challenge or scrutiny risk in future for sellers. The other specific requirement under tax rules is under the transfer pricing regime. Now, one would wonder how transfer pricing rules are applicable in a third-party transaction. So under the transfer pricing regime, let's take an example, discussing the same example further. The Group A or the parent entity in the US would generally be running the negotiations of the global sale with the buyer parent in the US. The local subsidiaries in each jurisdiction would generally not participate in deal negotiation. They will just assist in implementation of the terms which the parent entities may have agreed to. In these facts, transfer pricing rules deem such a third-party transaction as a controlled transaction because of the influence exercised by the offshore affiliates, and government would want to ensure that given the deal mechanics here, the offshore affiliates or parent entities should not enter into an arrangement where higher consideration is flowing offshore on offshore assets and the India consideration is suppressed to avoid India taxes. So therefore, this is a specific provision of law that sellers need to comply with, and for that it will have to ensure that the allocation of consideration to the India leg is on a fair value basis. Last but not the least, it's important for the sellers to have clarity on what contractual obligations it's agreeing to with the buyer, and should generally be aware of what to expect in tax negotiations so that they're fully prepared and can whatever comfort buyer expects, seller should also be equally comfortable in extending that comfort or protection to the buyers. So with that, we come to our last subtopic of the day, which is tax governance, tax negotiations, how each of those also vary in scope depending on the deal structure. So here we are depicting an asset transfer, a business transfer, and a share transfer agreement. And as you would notice, as we go from left to right side of the slide, we see that the nature of governance and provisions is also becoming more and more extensive. Why? Because in a share transaction, buyer is acquiring the whole entity with its legacy issues. So buyer would want absolute comfort on the tax status, tax compliances of the entity for the period in which seller was in control. And this is where sellers need to be fully prepared and be aware of what their tax compliance status has been. If anything needs to be disclosed, then that would need to be disclosed as part of the warranties in the transaction document. The other issue that you see common here is title related discussion and 281 related discussion in all three agreements. Now, in the last presentation, we had covered this topic in a great detail because this is an issue which impacts the buyer. And briefly, it's a title issue. It's because of the provision, Section 281 of the Income Tax Act. As per this provision, if sellers have pending proceedings or pending tax claims, and while the proceedings are pending, seller transfers any asset, but tomorrow is not able to pay the tax liabilities, then government or the tax department will have first charge over those assets. So buyers would want to be absolutely comfortable that tomorrow, their transaction should not be rendered as void because of seller's tax proceedings. And this is where sellers need to do that homework, and their teams should look at what kind of proceedings are going on against sellers. What is the status? What are the amounts involved? What is the likelihood of an adverse claim materializing? And is the seller comfortable that yes, there's not going to be a situation that tax authorities, raise a challenge against the validity of the transaction, and seller would be able to comfortably pay those tax dues. So if seller is prepared with answers to all these questions, then the tax negotiation around this 281 risk should be easier, because we see in the deals that we work on, a lot of time is spent on this point, and then sellers would need to do that check at that point in time and offer related explanations to the buyers. The other points will be GST, like we discussed in an asset transfer, GST would be applicable. So it's important for the agreement to lay out clearly that seller will be recovering GST from the buyers. In a BTA, clauses defining the deal construct are very important, especially where, given the nature of assets moving, or let's say there are no liabilities being transferred, but the transaction is still structured as a business transfer, which is possible in some cases. It shouldn't so happen that tax authorities look at the BTA or the business transfer agreement and say that this is an asset transfer, but seller tried to structure it as a business transfer only to avoid taxes. So from that perspective, how the deal is defined and documented in a business transfer agreement is very important. And in a share transfer agreement, we'll typically see some post-closing covenants and filings as well. And indemnity is also a common point across, depending on the deal structure, buyer's risk assessment, seller's comfort. So these are like larger negotiation points in deals. Other common points will be enabling withholding and TCS covenant, so that each party knows what one is complying with, what other has to, what tax cost the other may have to give up at source itself, and then claim a credit later on. Disclosures against warranties, knowledge qualifiers, again a topic that we have covered in great detail in our previous webinars. So even in tax context, tax warranties context, it's important for sellers to ensure that warranties are correct, and if any disclosure needs to be made, that's fully disclosed to the buyer. Specific versus general indemnities, again, depends on deal to deal. Survival period, monetary caps helps seller to have clarity on its maximum exposure instead of keeping it open and ended. So this is also an important for sellers to pay attention to and pick it up with buyers. Inclusions and exclusions to indemnity is also important from sellers' risk and eventual costs perspective. With that, in terms of a summary of what we've discussed so far, like we've discussed, tax implications for sellers vary depending on the deal structure. It's very important for sellers to compare tax costs in alternate structure options to see how much is the tax saving in one structure versus the other. And if the savings are substantial, then relook at the structure. If not, then maybe look at a structure which is working fine from the perspective of both the parties. Commercial feasibility, again, a very important consideration, because let's say, as we discussed, share sale may be most efficient, but in a company where, let's say, more than one businesses are being carried out and buyer is only interested in buying one business, in those facts, a share sale may not be commercially feasible unless seller first carves out the out of scope business, and the entity then carries out only the target business and then do a share transfer. So deal to deal commercial intention, commercial feasibility is also important. Again, very important for sellers to carefully review the contractual terms, what they are agreeing to, so that there's absolute clarity on what obligations are from a binding contract perspective. Last but not the least, laws are changing and there is no one size fits all in deals, and so-called market standard principles can be negotiated, and that's where advisors play a very important role in guiding their clients through the deal negotiations. And deals do happen, but in the best interest of both parties. So with that, we'll now take questions. Samir, over to you.
Thank you very much, Ritu. That was excellent. And why don't you catch your breath, grab a sip of water? I've been furiously busy just taking a look at all the questions that have come through on the portal. So we are doing well on time. So maybe we take another minute. Great. So ready when you are.
I am, yes.
There are a few different questions on earnouts. And I guess particularly in the share sale construct, what should be the seller's tax position if, let's say, an earnout is proposed or some other form of deferred consideration or milestone-based payment is proposed?
Okay, that's a good question from a seller tax incidence perspective, because it's pretty common in deals where seller's consideration on share sale is deferred. It could either be linked to milestones or aspects like continued employment of promoters with the buyer entity, etc. In those facts, what should a seller do from its own tax perspective? Should it be offering the earnout-based contingent or conditional payments to taxes upfront, or as and when they receive? Now, here we've had some rulings, but the prevailing view so far is that there is a reasonable position for sellers to take, that until and unless conditions are satisfied, income does not accrue to the seller, and therefore sellers should not be paying taxes on amount which is contingent. Where it's just a timing-based deferral of consideration. So let's say today only parties fix the amount that it will be, let's say, 50 lakh rupees, but just that it will be paid at the end of year 2, and then at the end of the year 3, additional amount will be paid. So it's only linked to timing. In those facts, the entire consideration should be offered to tax upfront because the amount is known. It's only subject to timing difference. So depending on what are the conditions attached to deferral of consideration, seller should take a call on whether income is accruing, not accruing. If we talk about the legal principles or the technical requirement under law, which has led to this controversy regarding taxability of deferred consideration. So in relation to capital assets, law prescribes that all income should be offered to tax in the year in which the capital asset is transferred. And that is where the issue arises, that while shares are transferred in year 1, the consideration may be received in year 2, year 3. So is that taxable today or later? And we've had contradictory rulings here. But the latest ruling, which has dealt with this issue in detail, it kind of confirms that if the payment is conditional, then it does not accrue to the seller. But what sellers should still keep in mind is that while taxability may arise at a they could take a position that they should offer the income to tax when it arises, accrues on satisfaction of conditions. It still relates to the year in which the transfer has happened. So it may have to incur or pay interest for the period in between the sale transaction and actual accrual of the deferred amount, and then pay taxes with interest at a later date.
Understood. So let me take something else which has come through on share sale. I'm reading as it is. How are tax consequences different in case of a 100% share sale versus a minority transfer of shares? Also, is there any difference in the basis of the tax calculation in both?
Okay, so in a share sale where there's a 100% sale by the controlling shareholders versus a minority share sale, the tax incidence and tax principles for sellers do not change. It's the same thing, sale consideration minus cost basis, depending on their period of holding. That's their tax cost on a share transaction, whether it's 100% or minority or even one share. What changes is the scope of warranties, indemnities in an SPA. So in a minority exit, where minority shareholder does not have control or visibility over operations of the entity, it is in a good position to say that it will not be, representing anything regarding company's tax compliance status, because minority shareholders may not have visibility on how the company has been doing in the past, what the tax compliance status has been. So from those, for those issues like contractual warranties, indemnities, that's where there's a difference between minority sale versus 100%. But purely from a tax cost for seller's perspective, there's no real difference.
Understood. And so therefore, the tax calculation in both remains the same. Perfect.
That's
right. Now, moving forward to, there's a question on BTAs that if we are transferring intellectual property as a part of a business, in the IP assignment, sometimes we write a separate consideration for stamp duty purposes. Does that impact slump sale treatment?
That does not, because in a slump sale, yes, it has to happen for a lump sum price, but law does recognize that if one has to attribute values for registration purposes, for stamp duty purposes, then that will not be viewed as allocation of consideration to the individual asset. So that does not disturb the slump sale analysis of the transaction.
There's another linked question, and this is on TDS on immovable property. So the question is, if you have to deduct TDS on the transfer of immovable property forming part of an undertaking, does that impact the integrity of the slump sale?
Oh, that's an important one, and we do look at these instances from a seller perspective. That does that amount to allocation of consideration to real estate? But the answer to that is more practical than legal, because in a business transfer, like I mentioned initially, it's a transfer of a business unit. So it's not transfer of individual assets and therefore buyer having to withhold tax on immovable property versus no withholding on other assets. But from a registration perspective, when buyers approach the registrar for registering the real estate in their name, what we do know is that registrars have a checklist, right? They will look at their checklist to see whether TDS has been done. They won't know the differences between real estate moving as part of asset transfer or as a business transfer, and therefore should not be treated as a separate asset. And we may not be able to convince a registrar by giving them the whole technical explanation. So in those facts, I think it's best to first get that clarity whether that particular registrar would be requiring a proof of TDS. If yes, buyer has no choice but to do TDS. And in those facts, what from a seller perspective or from a legal perspective, what's relevant is that buyer is doing that allocation, which buyer has to anyway do in its books. Right, buyer will allocate consideration to each asset. So what buyer is doing should not impact seller's slump sale characterization of the transaction.
Understood. So there are a couple of different questions on non-compete. So first, let's take a situation where a specific non-compete consideration is paid. How is that taxed in seller hands?
Right. So this has been an age-old controversy where earlier non-compete fee structures were common when law was not clear on taxation of non-compete fee, and that kind of offered an opportunity to optimize taxes, because there was a possible position that non-compete fee, being capital in nature, not a revenue receipt in the ordinary course, should not be subject to taxes. But now law has been amended to address this issue or a loophole, and non-compete fee now is subject to tax as business income generally. But if we look at the details of the provision, there's still two parts to non-compete taxation. One is, if it's a non-compete fee is taxable as business income only when it is a negative right. It is for agreeing to not carry on business. But if it is being paid for on a capital account, and it says if the payment is for transfer of a right to carry on business, then that's not revenue or a business receipt. So it really depends on what is the non-compete fee being paid for. Is the seller transferring its right to carry on business, or is the seller just agreeing to not carry on a particular business activity for X number of years, depending on how they agree to it? But generally speaking, again, we don't recommend our clients to get into the technical nuances of whether it's of category A, category B, if there's a non-compete fee being charged, because generally it is a negative covenant. And if it is being charged, it should be offered to tax as business income in the hands of the sellers. Taxable.
Now let's talk. Great. Now let's talk about a situation where there's no separate non-compete fees, but there are extensive non-compete covenants. Then what happens?
Now then I think it becomes a question of, and that's where we've had a ruling as well, where tax authorities looked at an SPA and they said that, okay, there is a lump sum consideration, nothing is allocated to non-compete, but non-compete is one of the covenants in an SPA, which means something is paid towards non-compete. And what that something is, tax authorities then sit and decide what should be that amount, which should be then taxed at a higher rate compared to the rate applicable to what is paid towards share transaction. And so this is where there is some level of doubt. It's not tested too much by the courts. Like, we don't have a ruling yet which has looked at other aspects of non-compete, because otherwise if we split a share transaction in its different rights, then no one will be able to figure how should the sale transaction be subject to tax, because there are various contractual rights, obligations in an SPA, and we can't allocate consideration to each. But if we do recommend our clients that instead of having this uncertainty, if let's say tomorrow tax authorities go down the same route, they look at the SPA and try and allocate something, instead of that, you control that allocation and decide what should be allocated towards non-compete and pay taxes on it, so that you know how much your tax incidence is going to be, versus in a situation where tax authority is doing that. Now, this recommendation also depends on the selling shareholders' tax residential status. If sellers are non-residents of India, then this allocation does not make sense, because to the extent one allocates something towards non-compete, that amount will not be subject to tax in India if the seller does not have a taxable presence in India, because nature of income is business income. So this issue is more relevant where the sellers are residents of India, as to allocate or not allocate, and if one doesn't allocate, then what is the risk? I should also add that it's not that in every deal we see parties allocating, but it's still, some do allocate some consideration towards non-compete purely from the perspective of limiting one's exposure. And at least we are not seeing too much litigation on splitting the amounts, how should non-compete fee be taxed, but it's just it may just be a matter of time where tax authorities may start picking it up more and more.
Understood. Just going back to BTS, because I think BTS clearly are the flavor of discussion. There's a question around, a buyer wants to contractually reduce the set of liabilities they are responsible for. How does that impact my slum sale tax treatment? What should I be wary of?
Right. So I think this is where, firstly, sellers should be driving this analysis, whether they are whatever is moving, assets, liabilities, the combination. Are they comfortable? Their internal accounting finance teams are comfortable that the transaction still qualifies, the test of being treated as a slump sale. If there is comfort, then exclusion of some liabilities should not impact the nature of the transaction, but it really depends on nature of business. For example, like I said, manufacturing business is a business which may have liabilities clearly identifiable, right? There could be business-related creditors, or some borrowing. If there's some borrowing that seller has taken in relation to that particular business activity, then it's a liability which is directly linked to that business. So I think it's something which should be looked at on a deal-to-deal basis. As a principle, so long as what is moving is a business, but some assets or some liabilities which are not directly linked to that business, if those are excluded, then still the transaction should be treated as slump sale. But if liabilities are absolutely excluded, that is when we have to look at it in a greater detail, that if it still meets the test of being a slump sale. But a factual question there is, what if the business does not have liabilities? It's not a business which would generally have a lot of liabilities, like let's say a services business. So I think answer there is business to business facts. What is the position of the seller with respect to that business vertical?
Great. There seem to be a few different questions on the basis of a seller being a non-resident. So I'll go one by one. I guess the first one is on TCS. You mentioned that TCS as a concept does exist. And let's say the seller has a favorable tax position from the past basis, which no withholding is attracted. Should they at all be looking at complying with TCS? Is that required, not required? What's the position?
Sameer, there we don't see a standard yet. We are seeing, of course, from a legal technical position perspective, we do know that this is an absolute gray area where whether it applies, not applies, there's lack of clarity. In terms of some indications from the government, the CBDT circulars that were issued in the context of this TCS provision, they do have some indication that government wants to consider shares and securities as goods subject to this provision. But generally speaking, how goods one would understand goods to mean or to imply is that it is something in the course of trading. So whether it should be applicable only when the seller is holding shares in the course of trading, like it's trading, does business activity, buying, selling activity in shares, or is it something that's holding as an investment, and therefore should that still be treated as goods? So the answer there is, so there's no answer. But if we talk about our deal experience and the positions that, you know, the non-resident funds, some funds are taking, if they have a PAN-TAN in India, which funds focusing on the Indian market may already have, if they have like transferred India investments in the past or earning any India income like dividends. In those cases, I would say it's just better to comply, because we don't know today, what if tomorrow there's a clarification from the government saying, no, we always intended shares to be covered by this provision. So it's better to comply instead of not complying and then having to live with this risk. If sellers do not have PAN-TAN registrations in India, I think only in those cases one should look at it that, okay, what is the risk? What happens if I do not comply? And if the timing allows, then yes, get PAN-TAN registration, comply. But in many deals where there's like time pressure to close, so I think only in those situations one should look at the technical analysis, but otherwise just generally comply to avoid the risk.
Understood. Now, withholding tax for a non-resident seller is always a vexed issue. I don't think it's ever been as settled. So one is, let's say, if a seller has agreed to full tax being withheld upfront by the buyer, then what sort of a position should they take on indemnification? How charitable or how hard should they negotiate it?
I think, so from a contractual perspective, what sellers would generally want to have a clean exit, right? So in a 100% exit from an entity, or financial investors, if they're exiting an Indian portfolio company, they would want a clean exit to the extent possible. So any post-closing obligations, indemnities, etc., they would want to avoid. So in factual situations where buyer is withholding taxes upfront, and there is no doubt or there is no real risk for the buyer tomorrow that it has not withheld taxes and therefore they are on the hook for seller taxes. In those facts, seller can very strongly push back on a specific tax indemnity. In those situations, also sellers do need to keep in mind that they should ensure that they provide all the documents, information to the buyers regarding their tax workings, tax computation basis which buyers will be withholding taxes. So long as both the parties are aligned that yes, it is a simpler situation, all taxes are being upheld. The computation is pretty simple. It's just a plus minus of sale consideration and costs involved. Then sellers should be able to push back on a specific transaction tax indemnity, and buyers also, we've seen buyers also being reasonable there. They do not then keep pushing for a specific tax indemnity. They'll rather bargain that for something else. So yes, that's a reasonable position to take, that for sellers to push back on a specific tax indemnity.
And let's say a seller is conscious of end of life, a financial sponsor, like you said, let's say they want to liquidate proceeds, share proceeds with their investors. What are the kind of precautions you see being palatable for buyers in concluded transactions?
Right. I think buyers having more sophisticated advisors, they would want to cover all these situations at the time of binding the deal documents. They would want to cover a situation of, what happens if seller funds life is limited, or they liquidate, distribute all the funds. So in those cases, seller could provide alternate comfort to buyers, like comfort from an affiliate, which is an entity of substance, does not have limited life, or a parent level comfort that if the seller fund liquidates, then parent will step in and take on the indemnity obligations. And the third bucket will be tax insurance, which is a product very common, at least in tax treaty exemption sale transactions, where insurer would then underwrite the risk, and even if the seller fund liquidates, insurer will step in if tomorrow there is a tax claim. So I would say contractual or insurance as a product. Insurance does come with a cost, so it will generally be preferred by more sophisticated buyers, sellers, ready to incur that cost.
Understood. Few different kinds of questions on valuation. One is, what are the different methods of valuation that you see being used or which are prescribed, and anything other specific around it? There's another question on timing. I'll come to that.
Right. So in terms of valuation methods, it really depends on the nature of asset. For shares, if it's equity shares, then it's the net book value method. Law prescribes a method. There's no flexibility to achieve a number that parties may want to achieve by way of valuations. So there's an objective formula, A minus B, looking at the balance sheet position of the entity whose shares are being valued. If entity has real estate or investments, shares, securities, these assets need to be separately fair valued as per the rules. For preference share valuation, there's more flexibility because there's no formula prescribed. Rules just say open market value, and the valuation may be determined by a merchant banker or an accountant. And that's where we typically see use of a discounted cash flow method, which is generally used even for FEMA purposes, while both laws do not prescribe a specific method. So generally, service companies, non-asset heavy companies, valuers would typically apply a DCF. So more flexibility in case of valuation of preference shares. If you talk about real estate, that also clearly laid out stamp duty value or the ready reckoner value will be the fair value of real estate. And business transfers, like we discussed, that's also a net book value kind of a test, where book value of assets and liabilities is considered, except where the business unit has real estate or investments, in which case those two assets will need to be fair valued separately.
There's a follow-on question. CCPS get treated as compulsorily convertible preference shares, get treated as equity shares or preference shares from a valuation perspective?
Short answer to that is preference shares, but long answer to that is it makes sense to look at the terms of the CCPS as well. It shouldn't so happen that CCPS has terms like an equity instrument, because an equity shareholder will have lesser rights but ownership rights in the entity, etc. But a CCPS holder will have preferential rights over other shareholders. So the rights package, one should look at it to see whether a preference shareholder has a right akin to an equity shareholder, and if yes, does that change the analysis? But generally speaking, for valuation purposes, it should be treated as preferences, because rules at least do not have substance-based determination that yes, you look at the rights package, but it's generally a good idea to pay attention to the rights package as well.
Understood. And in terms of timing, when is it that these valuations need to be undertaken? I mean, the specific question is, what is the cutoff date for tax valuation requirements? So I'm presuming that is what it refers to. And who should be doing this? Can the seller do these in-house, or do you necessarily need external valuers at each stage?
So that's a good one actually, because that does come up in deals where sellers, buyers are preparing for signing, executing, closing. So for these tax valuations, in terms of timing, the requirement is to get them as of closing. So if it's a share deal, then equity shares need to be valued as of closing, preference shares need to be valued as of closing, which does put a lot of pressure on the clients, that how to get that. If we are closing today, how do we get the valuations also today? And one more point to note is that for equity shares, the requirement is to look at the audited financials of the company as on the date of valuation, which will be the date of closing. So it's like practically impossible to achieve it while one is closing the transaction. So what we do see happening is take a practical call. You look at the financials as of a month prior or 2 months prior to closing. Look at the numbers. If the book, because for equity shares anyway, it's book value, and in a third party deal, the transaction value should be reasonably higher than a book value anyway. So for looking at the estimated fair value, one derives comfort that yes, this provision is not going to create any problem, even if we don't have a valuation as of closing. Close the transaction, and then post closing, just get the final valuation in place, because seller would have to report this number in its tax return. So from that perspective, good idea to have it in place post closing. But for the purposes of the transaction, often we see clients looking at 1 month, 2 month, 3 month prior financials when they work out the numbers. And the second part of the question, who needs to do it? That's where depends on the asset. Now, generally, rules do not require the valuation to be procured from an external valuer. Right? In a equity book value sort of working, sellers can do that in-house because it's based on balance sheet position of the seller. For preference shares, open market value, who can do it? Generally, the rule says that the seller may the parties may obtain an accountant or a merchant banker valuation. So rules use the term may. So again, it doesn't look like they want to bind anyone with getting an external valuation. But generally, in deals especially where one is getting the valuation, the other party is relying on that valuation, we do see entities engaging a local accountant or a big four firm or a merchant banker to conduct those valuations, so that both parties are comfortable. And from a transaction perspective, it's just better to have a proper valuation in place instead of conducting it in-house.
Great, thank you, Ritu. I think we're out of time, and thank you very much to our audience for such active participation. We will respond offline, like I said, to questions we couldn't take up. But before we conclude today's webinar, we have a short poll, and we request all of you to please take the poll. It will be on your screen shortly. We take this very seriously as a part of our continuous improvement program, and we will also separately send you a request for your feedback on the webinar. The form usually takes less than a minute to complete and provides us a tremendous amount of insight on future activities. Great, thank you. So thanks to everyone who participated in the poll. I can see we've got quite a number of responses. And just from today's webinar, it's quite clear tax concerns are universal and omnipresent. And given these concerns narrate the commercial priorities of parties, they literally impacted the root of how the transaction ought to be structured. And therefore, it's important to know these upfront, raise these aspects in the very initial stages. And that brings us to the importance of having quality, experienced, and expert advisors on your side. So I would like to thank the audience for attending, and I would like to thank Ritu for such a fantastic presentation. We hope you found the webinar and our entire M&A Academy series interesting and worth worthwhile investment of your time. We can't even begin to express how much we've enjoyed bringing it to you, and the response, as we've said before, has been overwhelming. Please do not hesitate to contact us regarding any matters arising from the webinar. Our contact information is on the slide in front of you. Thank you for your attendance today, and we look forward to being in touch at future webinars and when we renew the M&A Academy next year. Thank you very much, ladies and gentlemen.
Thank you so much.